start a meteorologist program.
Right, we seem to be live streaming early. I'm not quite sure why we'd be live streaming before we are starting the webinar. Can we start the webinar and let people on the invite? Sam? Hi, everyone, and welcome along. Welcome along to the Sunday market update from Access to Wealth. My name is Paul Bottrell, and I am your host today. Joining me in the show today, our trader from Brighton Beach or Hove in London, Ash Bill. In the UK, we've got Lloyd coming in from Singapore, and I believe we'll have Alexis coming in as well from Singapore. We're going, Lexi's I think, to go. Lexi's in?
Yeah, she probably needs to be given powers. She's in the other side of it.
Fantastic. Let's get Lexi some powers and get her over to here, and then we'll get straight on to her and get into fundamentals. Once Alexis is in, we will do fundamentals. Then we will do currency strength with index with Lloyd, and then we will do. Are we doing data today with you, Ash, or are we doing FTSE?
I think we do FTSE today.
Fantastic, man. I'm looking forward to hearing about that. Stock markets are really where it's at for me right now. Lexi, welcome. How are you?
Hello. Hi, I'm doing good.
Good, welcome along. Look, I'm going to restart the intro because you're a bit late in, or we've just been juggling through, so we'll start from now. Right here, we're going to open up the show with Alexis doing fundamentals live. Again, key drivers for the markets right now. There's a lot of big things happening that are moving markets. What lies ahead for us this week, Lexi? What should we keep an eye on as we go through the week?
All right, thank you, Paul. I'm just going to quickly share screen, and we're going to take a look at some. I've got something a little bit different this week to look at. Now, what I have here on my screen, just make sure I'm sharing the right one. All right, over here, I'm actually on a website called worldgovernmentsbonds.com. Now, this is interesting because I think the next period of the next period, when we are in times of uncertainty, what we do want to look at is world government bonds, right? So we want to see, so basically for those of you who are very new to bonds, the reasons why people or hedge funds, they put their money in bonds is mainly a flight to safety, right? Because if, for example, we are in a bear market, if the stock market isn't doing well and you need to hold on to your cash, sit on it and wait, for a better time to enter the stock market, where do you put your bonds? If you put it in a bank account, the interest is really miserable, right? But what the other option is to park your money in some form of bonds, because at least from bonds you have a ready stream of income, you can get a stream of interest payments, and it's also a very common way to diversify your portfolio as a form of safety, right? But when I talk about bonds, I'm mainly talking about government bonds, because if we're looking at corporate bonds, then of course, if companies can fail, so there is a risk in corporate bonds, and the risk in government bonds are then a lot lower, because if companies can fail, countries can't quite fail in that sense. The government has to intervene and not allow the country to fail. So I think the next play on currency or money flows will be in where do we park our idling funds, right? So there's two things that we are looking at in the bond markets. One is the yield, and the second part, of course, is how much do they need to buy in. So it's a combination of price and yield. And with the interest rate market heating up, right? A lot of the countries have already raised their interest rates. Interest rates are already going up. I think the next question is, while waiting for the stock market to recover, it might take weeks, it might take months, it might take years. We're not too sure on how that goes, right? Because inflation is so high now. In the meantime, for hedge fund managers, for pension fund managers, where do they park the funds for investors in an attempt to stabilize their portfolios, in an attempt to preserve their yearly returns, and then bond is actually the market that is getting a bit of interest right now. Now, what is interesting about bonds is this. There's an article from the Financial Times, right, that investors have pulled 50 billion from emerging bond funds in 2020. Now, of course, in bonds, there's also an element of speculation and risk. So why do people buy emerging market bond funds? Is because emerging market bond funds, they pay very high interest. So if we look at the bond funds, emerging markets will be like the smaller countries. For example, we have Vietnam 3%, we have Indonesia at 7%, we have Bangladesh 8%. You go all the way down the road, we have if you apparently buy a Zambian government bond fund, it's 27%. Of course, the rating isn't that great, so that's not the best way to go. But even the Class B funds, right? The Class B funds, you have Russia at 9%, Mexico 9%, Nigeria 11%, right? So these are a combination of emerging markets as well as newly developed countries or developing countries bonds, all right? So the attraction is there because by parking your money in these, I would say, subpar bond funds, you're right, what you are taking on a bit of risk, but what is the other aspect about it is that you get regular interest payments in that sense. So it is risky in the terms of the bond portfolio, but at least it kind of guarantees a certain amount of interest rate payments in that sense, right? So what's happening right now is we have the flight to safety, which means investors are moving away from risk. So all these funds that are emerging markets no longer become interesting because they are now deemed a little bit more, what I would say, risky, right? So what has happened is emerging markets, they are actually having a fund outflow, right? So because investors are pulling out from the bond market in emerging markets. So instead of high interest, riskier bonds, they are pulling out from these emerging market bond funds to pour it into what we call a safer bond fund. All right, what are the safer bond funds? Of course, will be the bigger developed countries, the more stable economies, right? So this is why there is an interest that I am interested in looking at the bonds. To be a bit more specific, I've cut them out a little bit here. So we have, for example, if you're talking about, okay, should we park your money in the Japanese yen? The Japanese yen, politically stable, or the Swiss also deemed politically stable, but the yields is so low, right? So the interest might not be as interesting to park your bond funds with a very low yield currency. But how about the UK at 2.25? The US is 3%, right? The US bonds are now very interesting right now because they have a higher yield as compared to their fellow developed countries, right? We have Australia 3.5, we have New Zealand 3.6, not too bad as well. UK 2.2. So I think the next couple of weeks, it will be interesting to see the market flows of these yields. So if I'm looking to trade, right, I am going to veer a little bit more towards the economies with a stabler bond market, because in the flight to safety, I think the money flows will be towards the bond side, especially if a lot of these economies are also tightening their monetary policy, which means they're no longer printing money, they're increasing interest rates. The money supply is a bit more controlled. All right, so I'm looking to a couple of these currencies. So if we want to narrow down now, I have always been a fan of the Australia and New Zealand economy in that sense. It hasn't been doing so well the last couple of weeks, but that might just be a retracement issue. So if we just take a quick look at some of the Australian and New Zealand currencies, probably might have to give it a bit of time for it to retrace or go down a little bit more, but we are reaching a couple of interesting levels, especially when we pair it with the weaker economies. It is actually interesting to see where it might go. So I have actually a combined index view over here. Let me just go to the FX list. All right, so the currencies now, for example, currencies mainly like the Aussie dollar, I won't really look at that because both of these currencies, I'm a bit bullish on the Aussie, I'm a bit bullish on the dollar as well. What I'm actually looking at are the currencies paired with a slightly weaker currency, for example, the Aussie yen. Now, I know the Japanese, the Japanese currently is going through a little bit of a social political upheaval at the moment, but policies won't change overnight. So I don't think the yen will strengthen straight away overnight. I think the baseline for the preference of a weaker Japanese yen is still there. So I'm not going to, I'm not going to buy the yen straight away just based on what happened over the weekend. Really sorry about that. But we are looking at possibilities of yen retracing and then opportunities to get back still in the direction of a weaker yen, all right? Because the policies for a weaker yen are still in place. It's not going to be changing overnight. So what I'm looking at is for currency pairs, like for example, the pound Aussie. All right, I think the Aussie in the longer term, in the mid to longer term, will outperform will outperform the pound. It's been in a range so far, but again, a lot of things has been happening on the UK side as well. So I expect a little bit more range bound for the pound while they try to figure out and sort out their political situation. But from a currency perspective, there is a potential for the pound to weaken against the Aussie. Maybe not too far because the baseline is already pretty low, but at least there's a little bit of space here that we are looking at. We are looking for it to fill in the next couple of weeks. All right. Pound Kiwi again, it has been sidelined for quite a number of while, but I am preferring my preference is to trade the Pound Kiwi towards the short side. All right, because fundamentally, the pound still has very high inflation. The bond yields are not as attractive as compared to the Aussie, the Kiwi, as well as the US. So these are the three currencies that I will focus on. But again, I will not trade Aussie, Kiwi, and dollars together because the three currently has a bit more attractive. They're a bit more attractive in terms of money flows towards the bond market. But what I would try to look at is for their strength against the other weaker currency pairs. All right, and that's all for me, Paul. Over to you. You're muted.
I'm mute. I don't want to put you on the spot too much, Alexis, but what happens with Sri Lanka? Government's going broke, defaulting on debt. Do their bonds get defaulted as well?
Well, I would say yes and no. I mean, if they do default, it's going to be very bad. But I think very similar to the Greek and the Spain bailout, we will have to see whether or not the global bank steps in to give them a hand. But definitely those bonds have really crappy ratings, and if it does default, it will be quite a big. Let me see. I think I got it on here. Okay, again, I wouldn't say it's impossible for a country to default on its bonds, all right? But, the probability of not getting help, and Sri Lanka, I think that in terms of its global impact is not as big, right? So if Sri Lanka defaults, it's not as big as compared to, for example, a Spain or, for example, to a Mexico, things like that. So they might or might not get help from the respective banks. They might print more money, so I will have to see what's the monetary policy over there in terms of their stand. But I would say that if you're looking at Sri Lanka at 22%, they don't have a very fantastic rating at this point, so it will be already a risk in terms. It's got an SD rating. I mean, to buy a Sri Lankan bond, it really is a risk on its own already.
SD, what's SD? Does that mean suspended?
Yeah, it's not suspended. Oh wait, let me just.
Invest in Scotch whiskey.
Yeah, that's the more.
That's give you a YouTube warning.
Yeah, it's the riskiest side. It's so risky that the website didn't allow me to click it. But yeah, yeah. So I think anything below a CCC, it's like super risky. I don't think we would even want to consider these. But these are just like for reference in terms of the comparison. If you are buying bonds, we are looking for A. Minimally B, but the triple A's are the A's are best, the B's are already subpar. So to go anything beyond the B, I wouldn't even touch a C bond, in that sense.
Cheers, Lexi. Thanks very much for the explanation. Much appreciated as always. So bonds are something to watch. We're a little bit bullish on the Aussie, the Kiwi, and the US dollar. Boy, interesting to see how high that thing can go. Had another flying week last week, didn't it?
Yeah, definitely.
Rightio, let's hear about talking about currency strength. Let's go to our currency strength expert. Lloyd's our man who talks currency strength. Thank you for that, Alexis. Let's talk currency strength with Lloyd. What are we looking at this week, Lloyd?
Afternoon, everyone. By the way, SD means selectively default. Yeah, so it means that they can default on some bonds, not all, but some. Yeah, so I do play bonds, so I'm in a precarious situation right now.
Yeah, the thought of default is not great news. Okay, mate, back to you.
All right, so I think from the currency, why am I in this? All right, so from the currency strength part, the good news is that I'm not changing anything. So usually that will interpret to me as downtrend still downtrend, uptrend still uptrend. Price might just be in certain consolidation for certain pairs. That's about the good news that I have. Now for the dollar index, previously you can see that it has a bit of a pullback. Now it's still going up strong to 110. So I think in these times of turmoil, it's really a better idea to actually bet against the USD. How high it will go, I don't know, but the trend will do its magic for me. So dollar is still ranking very highly for me, very strong. Now, second on my list is actually the Canadian index. Now, I I can't say that it's a downtrend, but I can say that it's consolidation. And the good thing is that you can see this last time that price actually bounced off this level, it shoot all the way back up to $80. So it is giving us a second look that, hey, I'm still bouncing, and this price action definitely confirms it. So come Monday and Tuesday, if there's any sign of bullishness on the Canadian index, this is one pair to actually long it. Good to be in consideration that this pair is also tightly linked to the oils. Yeah, so if we believe that oil is going to rally because of the current turmoil, then yeah, we can actually long the Canadian dollar. Now, third pair on my list is actually the pound index. So technically speaking, you can see that price is now at $120. The last time it's been to this area, which is back in 2019, it actually bounced up quite a fair bit. Yeah, so keep a lookout for this. Now, I'm not in a rush to get into buying the pound. Yeah, seeing that I still need further confirmation to any other pair that's paired with the pound. I would like to see a higher low. That's all I would like to see, but not in a rush to get in. As long as it's giving me a higher low, it more or less confirms what the index is telling me, and I'll be happy to get in. Now, the Aussie index is one that is currently a bit of confusing. It doesn't really show much bullishness or bearishness. It does broke the $70, and just I think 2 years back, it went all the way down to about $58, $57. Yeah. So, but this week it seems to be, last week it seems to be doing some back, a bit of retracement. So I'm giving it a bit of breathing space back to $70. From there, then I'll make a decision whether that is worth shorting this pair. Yeah, for this week, I'd rather sit out of Aussie. Now, Swiss is interesting. You can see that it gives us a bit of a gap. Bounce off this very nice level. Gap down, seems that it's heading back up to down to $100. Yeah, from there, we can see that more or less see that it's in a range. Yeah, so it's really in the middle of nowhere. Not a great pair to be bearish about, particularly bearish about. But yes, there's some weakness in it that we can actually take advantage of. Let's have a look at the Kiwi index. $60 is definitely in the view right now, so price is really in the middle. We can actually take a right down. Nothing much to be talk about this. Now, Euro is index. Euro is index. Euro is interesting in the sense that it gives us a pretty big gap, right? You can see that about 104, this level has hold even from the past, right? For this level has hold quite well, and now it just gaps down. Yeah, so it doesn't look as if price is about to close the gap, so it's racing down to $100. We can also be in for a right down. Yeah. And the last is yen. Can't really scroll back to see where it's been in this territory. So it's really, you can see that on the weekly chart, it has been consolidating at this level for the past 3 weeks. Yeah, on saying that, if you can get some nice position in at a very nice technical level, it should be continuing weakening as what the technical has suggested. So as such, let's look at some of the pairs that I'll be trading. I think I can say that one of them. So just a bit of an update. Now I know why my time frame is a bit back. So previously I was trading dollar yen. You can see that I was actually stopped out over here. That was I think a month back, but price retraced back to this very nice level. Got in. Yeah. So don't back get into dollar yet. So again this week, you can see that I'm still ranking the dollar index very high and yen very low. I'm just waiting for price to actually break off this level, a break and retest, and I'll be happy to get into a second time. The next pair that I'm going to get that I'll be looking to trade is actually Euro CAD. On the 4-hour chart, you can see very, very nice downtrend. Either I'm waiting for a better retracement. Now, to be clear, it doesn't seem that the price is giving me very deep retracement. So if it doesn't continue its current behavior, I'm just waiting for a break and retest of this level. It's going to be consolidating. Break and retest, that's in the play, and then I'll be happy to get it. Yep. So keep a lookout for dollar and Euro CAD for the upcoming week ahead. That's all for me, Paul.
Cheers, Lloyd. Thank you very much for that. Interesting stuff. We'll keep an eye on the dollar yen this week. It's going to be a goodie, I would imagine. Thank you very much for that. Rightio, so we're now going to do the FTSE with Ash for mine, an unusual chart. I don't associate regional periods of range with the FTSE. I'm a bit of a believer that it tends to move a little bit this one. But on the MT4 chart that I've got, still inside the range of the 16th of June.
Yes, it is in a bit of a range as it kind of decides what's going on. And it's an interesting dynamic, really, with investors right now, because the recession fears are building. And I guess, market participants are pretty much they're hoping for the Fed just to kind of give them some relief. That they just want the Fed just to back off a little bit and give them the chance for the recession just to go away a little bit, you know. So let's have a quick look at the fundamental data and what's going to happen over.
Before you do too much more, do you mind, mate? Boris Johnson's resignation to the market was completely priced in, just no reaction, basically, right?
I guess you could see it that way. I mean, it's very difficult to know what ended up being the main focus there, because Boris Johnson, yeah, he resigned, and I've got to say it shocked me, because I was speaking to Geoff and he said there's no way he's sticking around with this one, but he survived so many other things that I thought he may well survive this one. So I think it did take everybody a little bit by surprise. But I think ultimately the broader picture is much bigger than whether Boris Johnson resigns or not. So usually that would have some kind of impact. But I think that there are other things that are really going on that skew the picture a little bit. I think it will ultimately put the pound in a bit of strife, and that's why I think the pound is worth staying away from right now, because you look at that particular announcement and you think, well, that's going to move the market. One way or the other is going to move the market, and it didn't. So why didn't it? Well, I think that adds a bit of confusion, and you know, from that you kind of say it's better just to leave that alone and let it work its way out. You know, let's see if we can get some clarity. Then we'll go back towards the pound.
Right. Okay. Leave it to the FTSE. But let me take you off track.
No problem at all. So, so back to the FTSE. So the FTSE is actually a really fascinating index in this particular environment. If you were looking at growth, you look at the NASDAQ. The NASDAQ is a really good one when monetary policy is loose. People flood to the NASDAQ, as we saw, you know, after the COVID-19 bounce. It bounced hard, and it bounced for a long time, over doubled its price, because tech companies are able to get much more money. They're much more able to grow. They're much more able to do lots of R&D, and they do really well. Now, during recession, the FTSE is the one that is likely to be one of the worst performers. And the reason for that, and the reason for the NASDAQ doing so well, is the companies that make up the NASDAQ. The reason the FTSE could do quite badly here is the companies that make up the FTSE. It's much more connected to global growth because of the fact that it's got big oil companies in there and big commodity companies in there. So the makeup of the FTSE would suggest that if we are to get a recession, that would suffer quite badly, you know, because it is a cyclical. It's very attuned to the cycles of the business cycle. Very attuned to that. So if the business cycle is starting to weaken, the FTSE will potentially weaken. Now, what we've got is a Federal Reserve that the traders or investors are hoping are going to come out and say, look, maybe not 0.75, maybe 5, maybe 0.5, maybe net 0.75 next time, but maybe we can then start to move to 0.5. So the numbers have to reflect that. So really at this stage, numbers actually, if the worse the numbers are, in some respects, the better for the market, because the market wants the Fed to stop. And what we've really got sort of from last week was ISM Services PMI 55.3, not close enough to 50 for really to be that negative. Most significantly, unemployment rate still at 3.6 and average earnings still growing. That does not push the Fed towards a loosening policy. It continues for them to tighten. Next week is going to be significant, because next week what we got is the CPI data. Now, this will be watched on Wednesday, so watch out for Wednesday. I'm not saying the market won't move before that in potential anticipation, but that's the big day. Because if inflation is still hot and the unemployment data and the ISMs aren't particularly weak, then that backs up the Fed's position to go and attack price. They have a dual mandate, but right now they are focusing purely on the price and the fact that the price is getting so inflated everywhere. So they'll continue to go after it. So inflation comes out hot, bad for the stock market. And now we go back to the FTSE on the chart. This is the weekly. This is what's going on in the weekly. And if we look at the trend line here, and you could actually flip this to the monthly, but it's not so good. But this is the primary trend line here. That's the primary trend line that we saw in the FTSE. And if we sort of go back down to the weekly, we can probably tighten this up a little bit, and let's see if we can tighten it up sufficiently to get there. Probably can. We probably can. Maybe. No, I wouldn't be that comfortable with that. That's probably about as tight as we can get it. So this low that we saw not last week but the previous week is a significant level. That starts to break down. It could be quite significant for the FTSE, and it could be quite a lot lower. On the daily charts, what we've got is a bit of a mix, as you say, a bit of a kind of range. We're caught in this range. But look at these bars that are negative, very, very negative, the last bar there. This is very, very negative there. Yes, this one was quite positive, but all it did was push us back to these highs, and we're back down again. And then if we zone in here for the 4 hour, the 4 hour is suggesting that we are right on top of this area here. And this weekly pivot is going to change. So the weekly pivot might well be... the weekly pivot might well have moved below the price. We'd have to work it out, but we can see that there's definitely some resistance up here. There's an inverted head and shoulders, which should be bullish, but the data does not suggest that we should be looking for longs in the FTSE. The data suggests that we should be looking for shorts, but Wednesday's key. If Wednesday's CPI data comes in significantly lower, the market is likely to rally, because the market might start to assume that the Fed will ease back a little bit. If the CPI data comes in the same or higher, that's going to suggest further Fed action. That's going to suggest further choking of the economy. While the economy is doing okay, weakening, to be fair, the global economy is weakening, but it's doing okay. The Fed will feel comfortable that they can raise interest rates, not only once, but maybe another time quite aggressively. That's going to be bad for the FTSE. So as the market opens on Monday, check the price action, but be aware, Wednesday could turn things around. So if you are in a short and you've got some profit in the bank by Wednesday, my suggestion would be try and get stops at break even, or at least reduce the risk just in case the market turns around hard. You want to try and remain in the trade, because if the CPIs come out come out strong, the market is likely to tank after that. So quite a big week, mate, but Wednesday's the key day.
Cheers, mate. I put that weekly pivot into the market scan, 7155 coming up for the FTSE. You just got to click the weekly pivot button on the market scan, and gives you that number. So right in the middle of those current bars. It is a big week, isn't it? I think it's going to be another one of those things. It's really cool, isn't it, Ash? You know, we can do these shows, and there's times where you sit here for month after month and you say, look, there's not much going on. Be patient, wait for opportunities. And this week, we're in a period now where every week there's something going on. There's opportunities. And while the FTSE might be ranging, other stuff is trending. We've seen some big US dollar moves, some big moves in things like gold quite quickly. And some really good opportunities out there for those that want to take them. And again, one thing about the FTSE, Ash, I actually don't remember the last time I saw the FTSE sideways for 3 weeks. I can't think off the top of my head the last time I saw that happen. It's quite unusual. And I'd expect it to bang out of there in some stage and with some meaning, you know?
Yeah, absolutely right. And with the FTSE, the other thing that everybody needs to check is oil and copper, because of the as I say, the companies that are weighting the FTSE, Rio Tinto, Anglo America, Glencore are the sort of mining stocks. Then you've got Shell and BP, big players. So if you see the oil market come off and copper come off, which we've seen recently, you know, we're looking at oil just starting to show some potential weakness here, particularly on the daily chart. There is this little breakout point here. So if oil is coming off, then the FTSE is going to weaken as well. Copper has also had a bit of a problem as well recently. Watch those charts as well to get a pretty good idea and understanding of which direction the FTSE is going. Oil will need to get back into its upper range, really, for the FTSE to do well.
That trend line tells us big time for oil, right? You know, beautiful retest of that trend line. It's been support, it's been broken, it's been tested as resistance. And what happens Monday as we interact with that trend line will be blooming interesting as far as direction goes for the week there, right? Get a
absolutely, and again,
you're pretty bullish and get a bounce off that, and all of a sudden you're looking at, you know, you've got lower lows and lower highs, and a trend line holding, you're starting to look pretty seriously at trend change, right?
Absolutely right, mate. And Wednesday's pivotal again for the oil market. Wednesday's pivotal, CPI data. You know, all this stuff is interconnected. So the CPIs on Wednesday, I would say, are pivotal for most people that are trading this week. I would say that Wednesday's number is going to be pretty important.
I couldn't agree with you more, mate. So cheers for that, mate. Thank you very much. And with that, we will wind up the analysis part of today. Remember that next week, Linker and Orlando will be joining us, so make sure you join us for that. Linker on trend trading, Orlando on the US dollar, perhaps the most fascinating topic of them all at the moment. So join us same time next Sunday. We will see you then. To Alexis on fundamentals, to Lloyd on currency strength, to Ash on the FTSE. Thank you very much for your time, and to all of you who've joined us in the room, thank you. Those that have joined us on social media, Facebook, YouTube, Twitter, welcome along. Have a great week. And remember, guys, stay calm and make good decisions. If you do that, things do work out for you in the long run. Take care. See you all.